Question 1. Consider a scenario where a nonprofit organization relies heavily on volunteers for its community outreach programs. The organization's risk manager is tasked with developing a risk management strategy for these volunteer activities. The organization has limited financial resources, and the volunteer coordinator is concerned that overly stringent policies might deter potential volunteers. The risk manager must propose a strategy that effectively manages potential liabilities while maintaining the integrity and effectiveness of the volunteer program. Which of the following approaches best addresses the risk management needs for the volunteer program? A. Implement a comprehensive risk management framework that includes thorough volunteer screening, role-specific training, clear guidelines for activities, adequate supervision, and a robust incident reporting system, while also exploring cost-effective insurance options and communicating the value of these measures to the volunteer coordinator and potential volunteers. B. Focus primarily on securing the lowest cost liability insurance policy available to cover any potential claims, assuming that insurance will adequately protect the organization from all financial repercussions of volunteer-related incidents. C. Adopt a laissez-faire approach, assuming that volunteers are generally responsible individuals and that the organization's liability is minimal due to their unpaid status, thus requiring only basic waivers of liability. D. Delegate all risk management responsibilities for the volunteer program to the volunteer coordinator, trusting their judgment and experience without establishing formal policies or procedures. Option A. Adopt a laissez-faire approach, assuming that volunteers are generally responsible individuals and that the organization's liability is minimal due to their unpaid status, thus requiring only basic waivers of liability. Option B. Focus primarily on securing the lowest cost liability insurance policy available to cover any potential claims, assuming that insurance will adequately protect the organization from all financial repercussions of volunteer-related incidents. Option C. Delegate all risk management responsibilities for the volunteer program to the volunteer coordinator, trusting their judgment and experience without establishing formal policies or procedures. Option D. Implement a comprehensive risk management framework that includes thorough volunteer screening, role-specific training, clear guidelines for activities, adequate supervision, and a robust incident reporting system, while also exploring cost-effective insurance options and communicating the value of these measures to the volunteer coordinator and potential volunteers. The correct answer is D. Implement a comprehensive risk management framework that includes thorough volunteer screening, role-specific training, clear guidelines for activities, adequate supervision, and a robust incident reporting system, while also exploring cost-effective insurance options and communicating the value of these measures to the volunteer coordinator and potential volunteers. Explanation. This scenario presents a professional challenge because it requires balancing the organization's commitment to its volunteer program with its legal and ethical obligations to manage risks effectively. The risk manager must navigate potential liability arising from volunteer activities while ensuring the program remains viable and supportive of its volunteers. Careful judgment is required to implement policies that are both protective and practical. The correct approach involves developing and implementing comprehensive risk management policies and procedures specifically tailored to the volunteer program. This includes thorough volunteer screening, appropriate training, clear definition of roles and responsibilities, adequate supervision, and robust incident reporting mechanisms. This approach is ethically sound and aligns with regulatory expectations for due diligence in managing organizational risks, particularly those involving third parties. It demonstrates a proactive commitment to safeguarding volunteers, the organization, and the public from potential harm, thereby fulfilling the duty of care. An incorrect approach that focuses solely on minimizing insurance costs without addressing the underlying risks fails to meet regulatory requirements for risk management. This approach neglects the organization's duty to ensure volunteer safety and competence, potentially leading to incidents that could have been prevented. Ethically, it prioritizes financial expediency over the well-being of volunteers and the public. Another incorrect approach that involves ignoring potential risks due to the volunteer status of individuals overlooks the fact that organizations still owe a duty of care to those they engage, regardless of compensation. This can lead to significant legal liability if an incident occurs, and it is found that reasonable steps were not taken to mitigate foreseeable risks. It is ethically questionable to provide less protection to volunteers than to paid staff. A further incorrect approach that relies solely on volunteer self-reliance without providing adequate training or support is also professionally unacceptable. While volunteers are expected to act responsibly, the organization has a responsibility to equip them with the necessary knowledge and skills to perform their duties safely and effectively. This approach abdicates the organization's duty of care and can expose both the volunteer and the organization to undue risk. Professionals should adopt a decision-making framework that prioritizes a thorough risk assessment of the volunteer program, followed by the development and implementation of proportionate risk control measures. This framework should be guided by legal obligations, ethical principles of duty of care, and best practices in risk management, ensuring that the organization acts prudently and responsibly in managing its volunteer activities. Question 2. The audit findings indicate a discrepancy in how medical payments coverage was applied to a recent incident where a delivery driver, while making a delivery to the insured's business, tripped over a loose paving stone on the sidewalk adjacent to the business's entrance and sustained a minor leg injury requiring medical attention. The insured has expressed concern that the driver was not an employee and that the injury occurred outside the direct control of the business, suggesting that medical payments coverage should not apply. The auditor is questioning whether the insurer correctly interpreted the scope and applicability of the medical payments insuring agreement in this situation. Option A. The medical payments coverage should not apply because the injured party was not an employee of the insured and the injury occurred on a public sidewalk, which is outside the insured's direct control and premises. Option B. The medical payments coverage should apply because it is a no-fault coverage designed to pay for reasonable medical expenses incurred by individuals injured on the insured's premises or due to the insured's operations, and the delivery driver's injury arose from an activity directly related to the insured's business operations. Option C. The medical payments coverage should apply, but only if the insured can prove that the loose paving stone was a direct result of the insured's negligence, establishing fault for the incident. Option D. The medical payments coverage should apply, but only for the portion of medical expenses that the insured business owner personally deems reasonable and necessary after reviewing the driver's medical bills. The correct answer is B. The medical payments coverage should apply because it is a no-fault coverage designed to pay for reasonable medical expenses incurred by individuals injured on the insured's premises or due to the insured's operations, and the delivery driver's injury arose from an activity directly related to the insured's business operations. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire to minimize perceived unnecessary payouts and the insurer's obligation to adhere to policy terms and regulatory requirements. The auditor's findings highlight a potential misinterpretation or selective application of the medical payments coverage, specifically concerning its no-fault nature and its intended scope. Careful judgment is required to balance the client's perspective with the contractual and legal obligations of the insurance policy. The correct approach involves accurately interpreting and applying the medical payments insuring agreement as a no-fault coverage designed to pay for reasonable medical expenses incurred by individuals injured on the insured premises or due to the insured's operations, regardless of fault. This approach aligns with the fundamental purpose of medical payments coverage, which is to provide prompt, small-dollar medical payments to injured parties to prevent minor incidents from escalating into larger liability claims. Adhering to this interpretation ensures compliance with the policy contract and avoids potential regulatory scrutiny for misrepresenting coverage or unfairly denying claims. Ethically, it upholds the principle of fulfilling contractual promises, an incorrect approach that involves denying coverage for an injured visitor, because the insured believes the visitor was at fault fails to recognize the no-fault nature of medical payments coverage. This is a direct violation of the insuring agreement and misrepresents the policy's intent, potentially leading to regulatory sanctions for unfair claims settlement practices. Another incorrect approach, which involves limiting payments solely to what the insured deems reasonable, without reference to standard medical billing or policy definitions, constitutes an arbitrary and potentially discriminatory application of coverage, violating both contractual terms and regulatory expectations for fair claims handling. Finally, an approach that suggests excluding coverage for any injury occurring off-premises, even if directly resulting from the insured's operations, e.g., a delivery driver injured while making a delivery misinterprets the scope of the coverage, which can extend beyond the insured's physical premises if the injury arises from the insured's business activities. This misinterpretation could lead to the denial of valid claims and regulatory noncompliance. Professionals should employ a decision-making framework that prioritizes a thorough understanding of the policy's insuring agreements, exclusions, and limitations. This involves consulting policy wordings, relevant case law, and regulatory guidance. When faced with ambiguity or client pressure, the professional should clearly communicate the policy's terms and the rationale behind coverage decisions, ensuring transparency and adherence to both contractual obligations and regulatory standards. Escalation to underwriting or legal counsel may be necessary for complex interpretations. Question 3. Quality control measures reveal that a commercial client seeking to reduce their insurance premium has requested a significant reduction in the aggregate limit of their liability policy while maintaining the existing per occurrence limit. As their insurance broker, what is the most appropriate course of action? Option A. Advise the client that the aggregate limit is rarely reached and that the reduction will likely not impact their coverage significantly, proceeding with the requested change to secure the premium reduction. Option B. Inform the client that reducing the aggregate limit is a poor risk management decision and refuse to process the request, advising them to maintain the current higher aggregate limit. Option C. Explain to the client the implications of a reduced aggregate limit, including the potential for no further coverage if the aggregate limit is exhausted, and discuss alternative strategies to manage this risk while still addressing their premium concerns. Option D. Agree to the client's request to lower the aggregate limit and the premium without further discussion, as the client is dictating their needs. The correct answer is D. Agree to the client's request to lower the aggregate limit and the premium without further discussion, as the client is dictating their needs. Explanation. This scenario presents a professional challenge because it requires an insurance broker to balance the client's immediate desire for cost savings with their long-term risk management needs and the broker's fiduciary duty. The broker must navigate the potential for a significant gap in coverage that could arise if the aggregate limit is exhausted, without misrepresenting the policy's limitations. The challenge lies in communicating complex policy terms effectively and ethically, ensuring the client makes an informed decision rather than one based on incomplete or misleading information. The correct approach involves clearly and proactively explaining the implications of the aggregate limit to the client. This means detailing what the aggregate limit represents, how it differs from the per occurrence limit, and the potential consequences of reaching it, such as no further coverage for subsequent claims within the policy period. This aligns with the broker's ethical obligation to act in the client's best interest, providing them with the information necessary to make an informed decision about their risk management strategy. Regulatory frameworks, such as those governing insurance intermediaries, typically mandate transparency and a duty of care, requiring brokers to ensure clients understand the coverage they are purchasing. This proactive communication prevents misunderstandings and potential future disputes. An incorrect approach would be to simply agree to the client's request for a lower premium without fully explaining the impact of the reduced aggregate limit. This fails to uphold the duty of care and transparency expected of an insurance professional. Ethically, it could be seen as prioritizing a sale over the client's actual protection. From a regulatory standpoint, this could violate provisions requiring adequate disclosure and advice, potentially leading to a finding of misrepresentation or negligence if a claim arises that exceeds the exhausted aggregate limit. Another incorrect approach would be to dismiss the client's concern about the aggregate limit as a minor issue, implying it's unlikely to be reached. This downplays a significant risk factor and can be considered a form of misrepresentation by omission. It fails to provide the client with a realistic assessment of their potential exposure and undermines the principle of informed consent. Regulatory bodies often have strict rules against misleading clients about policy terms and conditions. A third incorrect approach would be to push for a higher aggregate limit without fully understanding the client's business operations and the likelihood of multiple large claims. While seemingly offering more protection, this could lead to unnecessarily high premiums for the client, failing to meet the objective of finding cost-effective risk management solutions. This demonstrates a lack of due diligence in assessing the client's specific needs and risk profile, which is a core ethical and regulatory expectation for insurance brokers. The professional decision-making process should involve a thorough needs analysis, clear communication of policy terms and their implications, and a collaborative approach with the client to find the most appropriate coverage that balances cost and protection. This includes explaining the function of both per occurrence and aggregate limits, discussing the client's risk appetite, and offering solutions that address potential coverage gaps. Question 4. Market research demonstrates that a significant number of businesses are seeking clarity on the scope of their employer's liability insurance. A company's employee, while on a work-related business trip, suffers a fall and sustains a fractured wrist. The employee claims this injury occurred due to a poorly maintained hotel carpet, which they tripped over while returning to their room after a client dinner. The employee's employment contract states that the company is responsible for travel and accommodation expenses during business trips. Which of the following best describes the likely coverage under Coverage B? Employer's liability. Option A. Coverage B is likely to respond as the injury occurred during the course of employment, and the employer has a legal liability for the employee's safety even when traveling for business, provided no specific exclusion applies. Option B. Coverage B is unlikely to respond as the injury was caused by a third party's negligence, the hotel, and not directly by the employer's actions or omissions in the workplace. Option C. Coverage B is unlikely to respond as the exclusion for injuries sustained while the employee is engaged in activities for personal benefit would apply, given the employee was returning to their room. Option D. Coverage B is likely to respond only if the employer had prior knowledge of the specific defect in the hotel carpet and failed to address it. The correct answer is A. Coverage B is likely to respond as the injury occurred during the course of employment, and the employer has a legal liability for the employee's safety even when traveling for business, provided no specific exclusion applies. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the employer's liability, Coverage B, insuring agreement, its exclusions, and limitations within the context of the UK regulatory framework and SISI guidelines. The complexity arises from distinguishing between claims that fall under employer's liability and those that might be covered by other liability policies or fall outside the scope of insurance altogether. Careful judgment is required to correctly interpret the policy wording and apply it to the specific facts of an employee's injury. The correct approach involves a thorough review of the employer's liability policy wording, specifically the insuring agreement, which typically covers an employer's legal liability for bodily injury or disease sustained by an employee in the course of their employment. This must then be cross-referenced with the policy's exclusions and limitations. For instance, the exclusion for claims arising from the employee's own negligence or willful misconduct, or claims covered by other specific insurance, must be carefully considered. The correct approach would be to determine if the employee's injury arose out of and in the course of employment, and if any exclusions or limitations apply to negate coverage. This aligns with the regulatory requirement for insurers to act with integrity, and to ensure that policyholders receive the coverage they are entitled to under the terms of their contract, as mandated by the Financial Conduct Authority, FCA, Principles for Businesses, and the SISI Code of Conduct. An incorrect approach would be to assume coverage based solely on the fact that an employee was injured during working hours, without scrutinizing the specific cause of the injury and its relation to the employment. This fails to consider the potential applicability of exclusions, such as those related to pre-existing conditions aggravated by employment, if not directly caused by it, or injuries sustained during activities outside the scope of employment. Another incorrect approach would be to deny coverage prematurely based on a superficial understanding of the exclusion for injuries sustained, while the employee is engaged in activities for personal benefit, without a detailed factual investigation. These approaches risk breaching regulatory obligations by failing to provide fair treatment to the policyholder and potentially misrepresenting the terms of the insurance contract. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the insuring agreement. Clearly define what the employer's liability policy is designed to cover. 2. Identify the facts. Gather all relevant details about the employee's injury, including the circumstances, cause, and any contributing factors. 3. Review exclusions and limitations. Carefully examine all policy exclusions and limitations to see if they apply to the specific facts. 4. Apply policy wording to facts. Make a reasoned judgment on whether the injury is covered, excluded, or limited based on the policy terms and the established facts. 5. Seek clarification. If there is ambiguity, consult with underwriting, legal counsel, or senior claims handlers. 6. Communicate clearly. Inform the policyholder of the decision and the reasons for it, referencing the relevant policy terms. Question 5. Strategic planning requires a thorough assessment of potential corporate exposures. When considering entity coverage for a manufacturing corporation, which approach best ensures the corporation itself is protected against a wide array of potential claims, including those arising from management decisions and employment practices, in addition to operational liabilities. Option A. Purchasing individual liability policies for each department manager to cover their specific operational risks. Option B. Relying solely on a comprehensive commercial general liability policy that covers bodily injury and property damage arising from the corporation's products and operations. Option C. Securing a robust commercial general liability policy that explicitly names the corporation as the insured and includes endorsements for vicarious liability, and supplementing this with directors and officers, D&O, liability and employment practices liability insurance, EPLI. Option D. Assuming that standard business insurance policies automatically extend to cover all corporate liabilities, without the need for specific entity-focused coverages. The correct answer is C. Securing a robust commercial general liability policy that explicitly names the corporation as the insured and includes endorsements for vicarious liability, and supplementing this with directors and officers, D&O, liability and employment practices liability insurance, EPLI. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a nuanced understanding of how commercial liability insurance policies are structured to protect not just the direct actions of employees or agents, but the entity itself from claims arising from its operations, management decisions, or vicarious liability. The difficulty lies in distinguishing between coverage for direct harm caused by the entity's negligence versus coverage for the entity's legal responsibility for the actions of others or for its own corporate failings. Misinterpreting the scope of entity coverage can lead to significant uninsured losses, reputational damage, and regulatory scrutiny. Careful judgment is required to ensure that the chosen insurance program adequately addresses the full spectrum of potential liabilities the corporation faces. Correct approach analysis. The correct approach involves a comprehensive review of the corporation's operational risks, management structure, and potential sources of vicarious liability, followed by the selection of insurance products that explicitly provide coverage for the entity itself. This includes ensuring policies like commercial general liability, CGL, are structured to cover the named insured the corporation for its own negligence, as well as for the negligence of its employees acting within the scope of their employment. Furthermore, it necessitates considering other coverages such as directors and officers, D&O liability, employment practices liability insurance, EPLI, and cyber liability, which are specifically designed to protect the entity from claims arising from management decisions, employment-related issues, and data breaches, respectively. This proactive and comprehensive strategy aligns with the regulatory expectation that businesses manage their risks effectively and maintain adequate insurance to protect stakeholders and ensure business continuity. The regulatory framework emphasizes the importance of robust risk management practices, and securing appropriate entity coverage is a cornerstone of this. Incorrect approaches analysis. Focusing solely on individual employee actions without considering the corporation's own potential liability or vicarious responsibility is an incorrect approach. This fails to acknowledge that legal claims can be brought directly against the entity for its own corporate negligence, failure to supervise, or for the actions of its employees for which it is legally responsible. Such an approach would leave significant gaps in coverage, potentially exposing the corporation to substantial uninsured losses. Relying exclusively on third-party liability insurance that only covers claims made against the entity for bodily injury or property damage caused by its products or operations, while neglecting coverage for management decisions or employment practices, is also an incorrect approach. This overlooks critical areas of corporate risk, such as claims arising from wrongful termination, discrimination, or alleged breaches of fiduciary duty by directors and officers. These types of claims are not typically covered under standard CGL policies and require specialized coverages. Assuming that standard liability policies automatically cover all forms of corporate liability without specific endorsements or separate policies is a dangerous misconception. Entity coverage is often defined by the specific terms, conditions, and exclusions within each policy. Without a thorough review and understanding of these policy details, the corporation may be operating under a false sense of security, leading to uncovered claims and financial distress. Professional reasoning. Professionals should adopt a risk-based approach. This involves first identifying and assessing all potential liabilities the corporation faces, considering both direct and vicarious liability. Subsequently, they must evaluate existing insurance policies to determine if they adequately cover these identified risks, paying close attention to the definition of the insured, the scope of coverage, and any relevant exclusions. Where gaps exist, professionals must research and recommend appropriate insurance products, such as D&O, EPLI, or specialized cyber liability policies, to ensure comprehensive entity coverage. This process should be documented and regularly reviewed to adapt to changes in the business environment and regulatory landscape. Question 6. The risk matrix shows a significant probability of damage to a commercial fleet of vehicles due to falling debris from nearby construction. Which of the following physical damage coverages would be the most appropriate to address this specific risk? Option A. Collision coverage, as it covers damage to the vehicles. Option B. Comprehensive coverage, ensuring it explicitly includes or can be endorsed to include damage from falling objects. Option C. Specified causes of loss coverage, limited to only fire and theft. Option D. Comprehensive coverage, assuming it automatically covers all types of physical damage without needing specific endorsements. Correct answer is B. Comprehensive coverage, ensuring it explicitly includes or can be endorsed to include damage from falling objects. Explanation. This scenario presents a professional challenge because it requires the risk manager to accurately assess the potential impact of a specific peril on a commercial property, and then to select the most appropriate insurance coverage to mitigate that risk. The challenge lies in understanding the nuances of different physical damage coverages and how they apply to distinct causes of loss, ensuring that the chosen coverage aligns with the identified risk and regulatory requirement without overinsuring or underinsuring. The correct approach involves selecting the coverage that specifically addresses the identified peril. This is the most professionally sound method because it directly aligns the insurance solution with the assessed risk, ensuring that the business is protected against the most probable and impactful physical damage. For example, if the risk matrix highlights a high probability of damage from hail, selecting a comprehensive policy that explicitly includes or can be endorsed to include hail damage is the most effective and compliant strategy. This approach adheres to the principle of prudent risk management, which mandates that insurance coverage should be tailored to the specific exposures faced by the business, thereby fulfilling the insurer's duty to provide appropriate coverage and the insured's expectation of protection against identified perils. An incorrect approach would be to select a broad, all-encompassing policy without a clear understanding of its specific inclusions and exclusions relative to the identified peril. This could lead to unnecessary premium costs if the broader coverage includes perils that are not a significant risk, or it could result in a coverage gap if the broad policy, despite its name, has exclusions that apply to the specific peril identified in the risk matrix. For instance, choosing a comprehensive policy without verifying that it covers specific perils like flood or earthquake, if those are identified as high risks, would be a failure to adequately address the assessed exposure. This demonstrates a lack of due diligence and could violate regulatory expectations for prudent risk management and appropriate insurance placement. Another incorrect approach would be to select a policy that only covers a very narrow set of perils, such as only fire and lightning, when the risk matrix indicates a higher likelihood of damage from other sources like windstorms or vandalism. This would result in underinsurance and a failure to protect the business against significant identified risks, potentially leading to substantial financial losses for the insured and a breach of the risk manager's professional duty to provide adequate protection. This approach fails to meet the fundamental purpose of insurance, which is to transfer significant, uncertain losses to an insurer. The professional decision-making process for similar situations should involve a systematic review of the risk matrix to identify specific perils and their potential impact. Following this, the risk manager must thoroughly understand the definitions, inclusions, and exclusions of various physical damage coverage options, such as comprehensive, collision, and specified causes of loss. The selection should then be based on a direct correlation between the identified risks and the coverage provided, ensuring that the chosen policy offers the most efficient and effective protection against the most probable and impactful threats, while also complying with any relevant regulatory guidelines regarding the adequacy of insurance coverage. Question 7. The performance metrics show a consistent decrease in the number of reported minor cyber incidents and a reduction in the average time to resolve IT issues over the past 2 fiscal years. However, the projected cost of data restoration and the potential business interruption losses from a single, large-scale cyber event have significantly increased due to the company's expanded digital footprint and reliance on cloud-based services. Given these conflicting indicators, what is the most prudent course of action for the commercial liability risk manager regarding the company's first-party cyber insurance coverage for data restoration and business interruption? Option A. Focus solely on third-party liability coverage, as the performance metrics indicate a reduced likelihood of claims related to data breaches. Option B. Proactively review and potentially increase the first-party coverage limits for data restoration and business interruption to align with the increased potential financial impact of a major cyber event. Option C. Maintain current first-party coverage limits for data restoration and business interruption, as the reduction in minor incidents suggests effective risk mitigation. Option D. Immediately reduce first-party coverage limits for data restoration and business interruption to capitalize on the observed cost savings from fewer minor incidents. The correct answer is C. Maintain current first-party coverage limits for data restoration and business interruption, as the reduction in minor incidents suggests effective risk mitigation. Explanation: this scenario presents a professional challenge because it requires a risk manager to balance the immediate financial implications of a cyber incident with the long-term strategic importance of robust first-party coverage, specifically for data restoration and business interruption. The challenge lies in interpreting the performance metrics not just as cost-saving indicators, but as potential signals of inadequate risk mitigation, which could lead to significant uninsured losses. Careful judgment is required to advocate for necessary coverage adjustments even when short-term cost reductions are apparent. The correct approach involves a proactive review of the cyber insurance policy's first-party coverage limits and sublimits for data restoration and business interruption in light of the identified performance metrics. This approach is correct because it directly addresses the potential gap between the insured's actual exposure to loss from a cyber event, as suggested by the metrics, and the existing insurance protection. Regulatory frameworks, such as those governing insurance solvency and consumer protection, implicitly require insurers and their representatives to ensure that policyholders have adequate coverage for foreseeable risks. Failing to recommend adjustments when metrics indicate potential underinsurance could be seen as a dereliction of duty, potentially leading to a breach of professional standards and regulatory noncompliance if it results in significant uninsured losses for the client. This approach prioritizes the client's financial security and the effectiveness of their risk management program. An incorrect approach would be to solely focus on the cost savings indicated by the performance metrics and maintain the current coverage levels. This fails to acknowledge that the metrics might be signaling an increased risk profile or a potential underestimation of the true cost of a cyber incident, particularly concerning data restoration and business interruption. This approach is professionally flawed because it prioritizes short-term cost reduction over adequate risk transfer, potentially exposing the insured to catastrophic financial losses that their insurance is intended to mitigate. It could also be viewed as a failure to act in the best interest of the client, a core ethical principle in risk management. Another incorrect approach would be to immediately recommend a significant increase in coverage limits without a thorough analysis of the underlying causes of the performance metrics. While increasing limits might seem like a solution, it could be an inefficient use of resources if the metrics are driven by operational issues rather than an inherent increase in cyber threat exposure. This approach lacks the analytical depth required for effective risk management and could lead to overinsuring certain aspects of the risk while neglecting others. A third incorrect approach would be to dismiss the performance metrics as irrelevant to insurance coverage, focusing only on the direct costs of claims. This is incorrect because first-party coverage, especially for business interruption and data restoration, is directly impacted by the frequency and severity of cyber incidents, which the performance metrics are intended to track. Ignoring these metrics means ignoring potential indicators of increased risk that necessitate a review of coverage adequacy. The professional reasoning process for similar situations should involve a comprehensive review of all available data, including performance metrics, incident reports, and industry threat intelligence, to assess the insured's evolving risk landscape. This assessment should then be used to critically evaluate the adequacy of existing first-party coverage, particularly for critical areas like data restoration and business interruption. Professionals must then be prepared to articulate the rationale for any recommended coverage adjustments to stakeholders, emphasizing the balance between cost and protection against potential financial devastation. Question 8. Quality control measures reveal that a catering company, Gourmet Bites, was hired to provide services at an outdoor corporate event. During the event, a guest tripped over an unsecured power cable that had been laid across a walkway by Gourmet Bites staff to power their equipment. The guest sustained a fractured wrist and incurred medical expenses and lost earnings. Gourmet Bites has a public liability insurance policy. Which of the following assessments most accurately reflects the potential for a negligence claim against Gourmet Bites, considering the elements of negligence? Option A. Gourmet Bites is likely to be found negligent because the guest suffered an injury at their event, and they had an insurance policy in place. Option B. Gourmet Bites is unlikely to be found negligent because the guest should have been more aware of their surroundings when walking at an outdoor event. Option C. Gourmet Bites is unlikely to be found negligent because they are a professional catering company and therefore presumed to operate with reasonable care, regardless of the specific incident. Option D. Gourmet Bites is likely to be found negligent because they owed a duty of care to event guests, breached that duty by leaving a power cable unsecured, and this breach directly caused the guest's fractured wrist and associated damages. The correct answer is A. Gourmet Bites is likely to be found negligent because the guests suffered an injury at their event, and they had an insurance policy in place. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of negligence principles within the specific regulatory framework governing commercial liability risk management and insurance in the UK, as per the CISI guidelines. The challenge lies in accurately identifying the presence or absence of each element of negligence when presented with a factual situation that may not be immediately clear-cut. A professional must not only understand the legal definitions, but also apply them to the practicalities of a business operation and its insurance coverage. The correct approach involves a thorough examination of the facts to determine if a duty of care was owed by the company to the injured party, if that duty was breached, if the breach directly caused the damages, and if quantifiable damages resulted. This aligns with the fundamental principles of the law of torts in the UK, which are implicitly understood and applied within the context of commercial liability insurance. Specifically, the Insurance Act 2015, while primarily focused on disclosure and warranties, operates within the broader legal landscape where negligence is a key factor in determining liability that an insurance policy might cover. The CISI syllabus emphasizes the practical application of these principles in assessing risk and insurance needs. An incorrect approach would be to assume negligence solely based on the occurrence of an injury. This fails to acknowledge that the law requires proof of all four elements. Another incorrect approach is to focus only on the existence of an insurance policy as a guarantee of coverage, without first establishing the underlying liability. This overlooks the principle that insurance is typically an indemnity against proven loss, not a blanket payment for any incident. Furthermore, an approach that dismisses the claim because the company has safety procedures in place, without critically assessing whether those procedures were adequately implemented and followed in the specific instance, is also flawed. This ignores the possibility of a breach of duty even when general safety measures exist. The professional decision-making process for similar situations should involve a structured analysis. 1. Identify the potential claimant and defendant. 2. Determine if a duty of care existed between them. This often involves considering the proximity of the parties and whether it was reasonably foreseeable that the defendant's actions or omissions could cause harm to the claimant. 3. Assess whether the defendant's conduct fell below the standard of care expected of a reasonable person or entity in their position. This involves examining the specific actions taken or not taken. 4. Establish a causal link between the breach of duty and the resulting harm. This typically involves the but-for test, but for the breach, would the damage have occurred? And considering whether the damage was too remote. 5. Quantify the damages suffered by the claimant. Only upon establishing all these elements can liability for negligence be confirmed, which then informs the assessment of insurance coverage. Question 9. Process analysis reveals that a commercial client is seeking to enhance their liability protection by purchasing an excess liability policy. The client has existing primary general liability and commercial auto liability policies with specific limits. The insurance broker is tasked with sourcing and recommending an appropriate excess liability policy. Which of the following approaches best demonstrates professional responsibility and adherence to regulatory expectations for providing excess liability coverage? Option A. Recommend an excess liability policy with a broad scope of coverage, focusing primarily on the overall limit of indemnity, and advise the client that it will provide additional protection without detailing its relationship to the underlying policies. Option B. Obtain copies of the client's current underlying liability policies, analyze their terms and limits, and then identify an excess liability policy that specifically provides coverage above those underlying limits, clearly explaining to the client how the excess coverage is triggered and any material differences in terms or conditions. Option C. Select an excess liability policy with a high aggregate limit and present it to the client, assuming they understand how it will respond in conjunction with their existing primary policies. Option D. Source an excess liability policy that mirrors the limits of the underlying policies but offers a slightly lower premium, explaining that it provides similar protection at a better value. The correct answer is C. Select an excess liability policy with a high aggregate limit and present it to the client, assuming they understand how it will respond in conjunction with their existing primary policies. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an insurance broker to balance the client's desire for comprehensive coverage with the practicalities and ethical considerations of providing excess liability coverage. The broker must ensure that the proposed excess policy genuinely adds value and is not merely a redundant or misleading product. Misrepresenting the coverage or failing to adequately explain its limitations can lead to significant financial and reputational damage for both the client and the broker. The broker's fiduciary duty to the client necessitates a thorough understanding and transparent communication of the excess policy's relationship to the underlying limits. Correct approach analysis. The correct approach involves a detailed review of the client's existing underlying liability policies, including their limits, deductibles, and exclusions. The broker must then identify a suitable excess liability policy that provides coverage above these specific underlying limits, ensuring there are no gaps or unintended overlaps. Crucially, the broker must clearly explain to the client how the excess policy functions, its trigger point for coverage, and any conditions or limitations that apply. This transparent communication ensures the client understands the true scope of their enhanced protection and can make an informed decision. This aligns with regulatory requirements for fair dealing and professional conduct, emphasizing the need for accurate advice and suitability of insurance products. Incorrect approaches analysis. One incorrect approach is to simply select an excess liability policy with a high limit without verifying its alignment with the underlying policies. This fails to ensure that the excess coverage is truly above the existing limits and could result in a situation where the excess policy does not respond as expected in a claim, leaving the client underinsured. This constitutes a failure in due diligence and potentially misrepresentation of coverage. Another incorrect approach is to assume the client fully understands the mechanics of excess coverage and to provide only a summary of the excess policy's limits. This neglects the broker's responsibility to educate the client on the interplay between the underlying and excess layers of coverage, the conditions for the excess policy to respond, and the potential for the excess policy to have its own specific exclusions or conditions that might limit its effectiveness. This lack of clear explanation can lead to a misunderstanding of the overall risk management strategy. A third incorrect approach is to recommend an excess policy that has significant differences in terms or conditions compared to the underlying policies without explicitly highlighting these discrepancies to the client. This could lead to unexpected claim denials or disputes, as the excess insurer might argue that the differences in terms mean the conditions for excess coverage have not been met. This demonstrates a lack of professional care and transparency. Professional reasoning. Professionals should approach this situation by adopting a client-centric, information-driven process. This involves 1. Thoroughly understanding the client's existing insurance program and risk profile. 2. Conducting comprehensive research to identify excess liability products that genuinely enhance the client's protection and are compatible with their underlying policies. 3. Prioritizing clear, unambiguous communication with the client, explaining the function, triggers, limitations, and benefits of the proposed excess coverage in relation to their existing policies. 4. Documenting all advice and client decisions to ensure accountability and a clear record of the risk management process. Question 10. System analysis indicates that a commercial general liability insurer is handling a claim where the potential indemnity payout is approaching the policy limit of $1,000,000. The defense costs incurred to date have reached $800,000, and ongoing litigation suggests these costs will likely exceed $1,000,000. Considering the regulatory framework for commercial liability insurance, which approach best aligns with the insurer's obligations regarding supplementary payments. Option A. The insurer should continue to pay defense costs in full, as these are typically considered supplementary to the indemnity limit and do not erode it. Option B. The insurer and the insured should share the defense costs on a pro rata basis, with the insurer covering a portion equivalent to the remaining indemnity limit. Option C. The insurer should inform the insured that they are now responsible for all defense costs moving forward, as the indemnity limit is nearly exhausted. Option D. The insurer should cease paying defense costs once the total defense expenses reach the policy's indemnity limit of $1,000,000. The correct answer is A. The insurer should continue to pay defense costs in full, as these are typically considered supplementary to the indemnity limit and do not erode it. Explanation. Scenario analysis. This scenario presents a common challenge in commercial liability insurance, where the insurer's duty to defend can extend beyond the policy limits for indemnity. The professional challenge lies in accurately interpreting the policy wording and relevant regulations to determine the extent of the insurer's obligation for defense costs when the underlying liability claim is substantial. Misinterpreting this can lead to disputes, financial strain for the insured, and potential regulatory scrutiny for the insurer. Correct approach analysis. The correct approach involves recognizing that supplementary payments, such as defense costs, are typically considered separate from and in addition to the policy's indemnity limits. This means the insurer's obligation to defend the insured may continue even if the cost of defense reaches or exceeds the policy's stated limit for damages. This interpretation is generally supported by standard commercial general liability policy language and regulatory interpretations that emphasize the insurer's duty to defend as a core coverage element, often explicitly stating that defense costs do not erode the indemnity limit. The regulatory framework for commercial liability insurance typically mandates fair claims handling practices, which include honoring the full extent of the agreed-upon defense coverage. Incorrect approaches analysis. An approach that limits defense costs to the indemnity limit fails to acknowledge the distinct nature of supplementary payments as typically defined in commercial liability policies and often mandated by regulatory guidance. This approach would be a breach of contract and potentially a violation of Fair Claims Practices regulations, as it would deny coverage for a significant part of the insurer's contractual obligation. An approach that suggests the insured is solely responsible for defense costs once the indemnity limit is approached or exceeded is incorrect because it ignores the insurer's contractual duty to defend, which is a fundamental aspect of liability insurance. This would leave the insured exposed to significant legal expenses without the promised protection, leading to potential financial ruin and regulatory complaints. An approach that proposes a pro rata sharing of defense costs between the insurer and the insured based on the indemnity limit is also incorrect. While some policies might have specific clauses for shared defense in certain complex scenarios, e.g., multiple insureds or multiple policies, a general pro rata sharing based solely on the indemnity limit is not standard practice for defense costs, and would likely contravene policy terms and regulatory expectations regarding the insurer's duty to defend. Professional reasoning. Professionals should approach this situation by meticulously reviewing the specific policy wording related to supplementary payments and the duty to defend. They must then consult the applicable regulatory framework for commercial liability insurance within their jurisdiction to understand any specific mandates or interpretations regarding defense costs. If ambiguity exists, seeking legal counsel or clarification from regulatory bodies is advisable. The decision-making process should prioritize fulfilling contractual obligations and adhering to regulatory requirements for fair claims handling. Question 11. The efficiency study reveals that the company's new industrial cleaning solvent, while innovative, involves complex chemical formulations. The risk management team is assessing potential liabilities. Which of the following best reflects the primary consideration regarding potential liability for harm caused by this solvent, assuming it is found to be defective and causes injury to a user? Option A. The company will be liable if the user can prove the company was negligent in its manufacturing process. Option B. The company will not be liable for harm caused by industrial products, as these are considered to be used at the user's own risk. Option C. The company will be liable if the solvent is found to be defective and causes harm, regardless of whether negligence can be proven. Option D. The company will only be liable if the solvent's defects were known to the company at the time of sale. The correct answer is A. The company will be liable if the user can prove the company was negligent in its manufacturing process. Explanation. This scenario is professionally challenging because it requires a risk manager to distinguish between situations where fault must be proven and those where liability attaches automatically, regardless of fault. Misinterpreting strict liability can lead to inadequate insurance coverage, incorrect risk mitigation strategies, and significant financial exposure for the business. Careful judgment is required to correctly identify activities or products that fall under strict liability regimes. The correct approach involves recognizing that the manufacturing and sale of a new industrial cleaning solvent, particularly one with potentially hazardous chemical properties, inherently carries a risk of harm to users and the environment. Under strict liability principles, if the product is defective and causes harm, the manufacturer is liable even if they exercised all reasonable care in its production. This aligns with the regulatory framework that aims to protect consumers and the public from inherently dangerous products by placing the burden of loss on the party best able to control the risk and absorb the costs. The focus is on the product's condition and the resulting harm, not the manufacturer's intent or negligence. An incorrect approach would be to assume that liability only arises if negligence can be proven. This overlooks the core tenet of strict liability, which is that fault is irrelevant. By focusing solely on whether the company followed industry best practices or had adequate safety protocols, this approach fails to acknowledge that a defective product causing harm can lead to liability irrespective of such precautions. This represents a significant regulatory failure, as it underestimates the potential legal exposure and leaves the business vulnerable to claims where fault is not a necessary element of proof for the claimant. Another incorrect approach would be to dismiss the possibility of strict liability because the product is intended for industrial use. Regulatory frameworks often extend strict liability to products used in commercial settings if they pose a significant risk of harm due to defects. The nature of the product, a chemical solvent, and its potential for causing injury or environmental damage are key factors, not the intended user. This approach fails to consider the inherent dangers associated with certain types of products, regardless of their market. A further incorrect approach would be to rely solely on contractual indemnities from suppliers of raw materials. While indemnities can shift financial responsibility between parties, they do not negate the primary liability of the manufacturer under strict liability laws. The injured party will still pursue the manufacturer directly, and the manufacturer's recourse through indemnities is a separate matter. This approach incorrectly assumes that contractual agreements can entirely shield the company from direct legal responsibility under strict liability. The professional decision-making process for similar situations should involve a thorough review of the product lifecycle, from design and manufacturing to marketing and distribution. Risk managers must identify activities that are inherently dangerous or products that, if defective, could cause significant harm. This requires understanding the specific legal definitions and applications of strict liability within the relevant jurisdiction. Consulting legal counsel specializing in product liability and risk management is crucial to accurately assess potential exposures and implement appropriate insurance and risk control measures. The focus should always be on identifying potential liabilities that arise irrespective of fault, ensuring comprehensive protection. Question 12. Quality control measures reveal that a client's D&O insurance policy has distinct coverage sections, Side A, Side B, and Side C. The client, a CEO, has asked for a simple explanation of what their policy covers, expressing concern about personal liability. Which approach best addresses the CEO's request while adhering to professional and regulatory standards for explaining D&O coverage? Option A. Provide a summary of the policy's exclusions and deductibles, as understanding what is not covered is paramount for managing personal risk. Option B. Explain that the policy provides a total limit of coverage for all types of claims, and the CEO's personal liability is covered up to this aggregate amount. Option C. Focus solely on Side A coverage, as this is the most direct protection for individual directors and officers against personal liability claims. Option D. Detail the specific purpose and scope of Side A coverage, directors and officers liability. Side B coverage, company reimbursement for indemnification. And Side C coverage, entity securities liability, clarifying how each part functions and what it protects. The correct answer is B. Explain that the policy provides a total limit of coverage for all types of claims, and the CEO's personal liability is covered up to this aggregate amount. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires the insurance broker to navigate a complex D&O policy structure while facing pressure from a client who may not fully grasp the nuances of their coverage. The broker must balance the client's immediate perceived needs with the accurate application of policy terms and regulatory expectations, ensuring the client receives appropriate advice without misrepresenting coverage. The ethical dilemma arises from the potential for miscommunication or misunderstanding to lead to inadequate coverage and subsequent financial harm to the insured individuals or the company. Correct approach analysis. The correct approach involves clearly explaining the distinct functions of Side A, Side B, and Side C coverage to the client. This includes detailing that Side A provides coverage for individual directors and officers when the company cannot or will not indemnify them. Side B covers the company's indemnification of its directors and officers, and Side C provides coverage for the company itself for securities claims. This approach is ethically sound and regulatorily compliant because it ensures transparency and informed consent. By accurately describing each coverage part, the broker fulfills their duty of care and avoids misleading the client about the scope of their D&O protection, aligning with principles of good faith and fair dealing expected in insurance advisory roles. Incorrect approaches analysis. An approach that focuses solely on the total policy limit without differentiating between coverage parts is professionally unacceptable. This fails to educate the client on how their premium is allocated and the specific risks each part is designed to mitigate. It can lead to a false sense of security, as the client might assume the entire limit is available for any type of claim, which is not the case with D&O policies. This misrepresentation, even if unintentional, violates the duty to provide accurate information. Another incorrect approach is to only explain Side A coverage, assuming it is the most critical. This overlooks the significant protection offered by Side B, company indemnification, and Side C, entity coverage for securities claims, which are often equally vital depending on the company's structure and risk profile. This selective explanation can leave the client vulnerable in areas not covered by their limited understanding. Finally, an approach that suggests all claims will be paid from the total limit without clarifying the separate retentions or sublimits applicable to each coverage part is also problematic. This can lead to the client misunderstanding the actual out-of-pocket exposure for the company or individuals, depending on the nature of the claim and the policy structure. Professional reasoning. Professionals in this situation should adopt a structured approach to client education. First, they must thoroughly understand the D&O policy's specific terms and conditions, including the definitions of each coverage part and any applicable retentions or exclusions. Second, they should prepare clear, concise explanations of Side A, Side B, and Side C coverage, using analogies or examples if helpful, but always remaining factually accurate to the policy. Third, they must engage in an open dialogue with the client, allowing for questions and ensuring comprehension. This process prioritizes client education and informed decision-making, thereby upholding professional integrity and regulatory compliance. Question 13. The monitoring system demonstrates that a client, a small e-commerce business, has received a demand letter alleging that their online advertisements contained misleading statements about a competitor's product, causing financial harm. The demand letter claims the advertisements constituted unfair competition and deceptive advertising. The commercial general liability policy in place includes coverage B, personal and advertising injury liability. Which of the following represents the most appropriate initial step in assessing potential coverage under this policy? Option A. Review the specific wording of coverage B's insuring agreement to determine if unfair competition or deceptive advertising fall within its defined offenses, and then meticulously examine all applicable exclusions and limitations within the policy to see if the alleged conduct is barred or restricted. Option B. Immediately deny coverage based on the assumption that unfair competition and deceptive advertising are not typically covered under coverage B. Option C. Advise the client to immediately cease all advertising activities to prevent further potential claims, regardless of coverage. Option D. Interpret advertising injury broadly to include any negative statement made in advertising, assuming coverage B will apply to the demand letter. The correct answer is B. Immediately deny coverage based on the assumption that unfair competition and deceptive advertising are not typically covered under coverage B. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of the personal and advertising injury liability coverage, coverage B, within a commercial general liability policy, specifically concerning the interpretation of its insuring agreement and exclusions. The challenge lies in distinguishing between claims that fall within the scope of coverage B and those that are explicitly excluded or limited, necessitating a careful review of policy language against the factual circumstances of the alleged injury. Professional judgment is crucial to avoid misinterpreting the coverage, which could lead to inadequate risk management advice or improper claims handling. The correct approach involves a thorough examination of the policy's insuring agreement for coverage B, which typically covers offenses such as libel, slander, false arrest, malicious prosecution, wrongful eviction, and invasion of privacy, as well as advertising injuries like copyright infringement in advertisements. This approach then requires a meticulous assessment of the policy's exclusions and limitations to determine if the specific allegations made against the insured are barred or restricted. For instance, if the claim involves intentional acts by the insured that are not reasonably expected to result in injury, or if it relates to prior publication, these would likely be subject to exclusions. The correct approach prioritizes adherence to the policy contract and relevant regulatory guidance, ensuring that coverage decisions are based on a precise interpretation of the policy terms and conditions as they apply to the facts. This aligns with the professional duty to act with due care and skill, providing accurate advice and managing risks effectively within the established legal and contractual framework. An incorrect approach would be to broadly interpret coverage B without considering the specific exclusions. For example, assuming coverage for any claim involving reputational damage without verifying if it meets the definition of libel or slander under the policy, and without checking for exclusions related to intentional acts or prior publication would be a failure. This overlooks the contractual limitations of the policy and could lead to the insurer or insured being exposed to liabilities not intended to be covered. Another incorrect approach would be to dismiss a claim solely based on a superficial understanding of the allegations, without a detailed review of how the specific facts align with the insuring agreement and any applicable exclusions. This demonstrates a lack of due diligence and can result in either an unwarranted denial of coverage or an improper acceptance of a claim outside the policy's scope, both of which carry significant regulatory and ethical implications, including potential breaches of contract and regulatory noncompliance. Professionals should adopt a systematic decision-making process that begins with a clear understanding of the insured's business operations and potential liabilities. This should be followed by a detailed review of the commercial general liability policy, paying close attention to the specific wording of coverage B, its insuring agreement, and all associated exclusions and limitations. When a claim arises, the professional must gather all relevant facts and compare them meticulously against the policy provisions. If there is ambiguity, seeking clarification from legal counsel or the insurer is a critical step. The ultimate decision regarding coverage must be grounded in a precise interpretation of the policy contract, supported by regulatory guidelines and ethical obligations to act in good faith towards the insured. Question 14. Operational review demonstrates that a key supplier contract for a manufacturing firm includes a broad indemnification clause, where the firm agrees to indemnify the supplier for any losses arising from the firm's use of the supplier's products, even if the supplier is also negligent. The firm's commercial general liability (CGL) policy is being reviewed. What is the most appropriate risk management action regarding potential insurance coverage for this indemnification obligation? Option A. Advise the firm to exclude this indemnification clause from all future contracts to avoid potential coverage disputes. Option B. Assume the CGL policy will automatically cover the indemnification obligation as it is a contractual liability. Option C. Confirm if the indemnification clause qualifies as an insured contract under the CGL policy, and if the potential liabilities fall within the policy's insuring agreements for bodily injury and property damage. Option D. Rely solely on the wording of the indemnification clause to determine the extent of insurance coverage, without reviewing the CGL policy's specific definitions and exclusions. Correct answer is C. Confirm if the indemnification clause qualifies as an insured contract under the CGL policy, and if the potential liabilities fall within the policy's insuring agreements for bodily injury and property damage. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how contractual liabilities, specifically those arising from indemnification clauses, interact with insurance coverage. The risk manager must not only identify the potential liability, but also determine the appropriate insurance response, considering the limitations and scope of commercial general liability policies. The core challenge lies in accurately assessing whether the indemnification obligation creates a direct liability for the insured that is covered by their CGL policy, or if it represents a contractual assumption of liability that might be excluded. The correct approach involves a thorough review of the indemnification clause within the context of the underlying contract and the insured's CGL policy. This requires understanding that a CGL policy typically covers the insured's liability for bodily injury or property damage caused by an occurrence, and it may also cover liability assumed under an insured contract. The key is to determine if the indemnification agreement qualifies as an insured contract, as defined by the CGL policy. If it does, and the underlying liability is for covered damages, then the CGL policy would respond. This approach aligns with the principle of ensuring adequate insurance protection for foreseeable and insurable risks arising from contractual obligations, as mandated by prudent risk management practices and the general intent of commercial insurance. An incorrect approach would be to assume that all indemnification clauses automatically trigger coverage under a CGL policy. This fails to recognize that CGL policies have specific definitions and exclusions, including those related to contractual liability. For instance, if the indemnification clause is interpreted as an assumption of liability for something the insured did not cause, or if it extends beyond the scope of bodily injury or property damage, it might fall outside the policy's coverage. Another incorrect approach would be to disregard the indemnification clause entirely, assuming it is purely a contractual matter with no insurance implications. This ignores the potential for the insured to be held liable for damages that could otherwise be insured, thereby failing to manage the risk effectively. A third incorrect approach would be to rely solely on the wording of the indemnification clause without consulting the CGL policy's definitions and exclusions, particularly the insured contract definition and any related exclusions. This can lead to a misinterpretation of coverage and inadequate risk transfer. The professional decision-making process for similar situations should involve a systematic review. 1. Identify the contractual obligation. Clearly understand the scope and nature of the indemnification agreement. 2. Analyze the underlying risk. Determine the potential types of losses, e.g., bodily injury, property damage, that could arise from the indemnification. 3. Consult the insurance policy. Carefully examine the CGL policy, paying close attention to the definition of insured contract, relevant exclusions, especially contractual liability exclusions, and the insuring agreements. 4. Seek expert advice. If there is ambiguity, consult with legal counsel specializing in contract law and insurance law, as well as the insurer or broker, to clarify coverage. 5. Document the decision. Maintain clear records of the analysis, consultations, and the rationale for the chosen course of action. Question 15. The monitoring system demonstrates a pattern where claims adjusters are frequently agreeing to settlements that exhaust the available policy limits in cases where there is a significant risk of a judgment exceeding those limits, without consistently obtaining explicit, informed consent from the insured regarding potential excess liability. Which of the following actions by the insurer best upholds its obligations to the insured in such circumstances? Option A. The insurer proceeds with settling the claim at the policy limit, assuming the insured will be notified after the settlement is finalized. Option B. The insurer seeks and obtains the insured's written consent to the proposed settlement after fully disclosing the potential for excess liability and advising the insured to seek independent legal counsel. Option C. The insurer delays the settlement process indefinitely, citing ongoing investigation, to avoid making a decision on the settlement amount. Option D. The insurer informs the insured that the settlement is in the insurer's best interest, and that the insured has no recourse if a judgment exceeds the policy limit. The correct answer is A. The insurer proceeds with settling the claim at the policy limit, assuming the insured will be notified after the settlement is finalized. Explanation. This scenario is professionally challenging because it requires balancing the insurer's contractual rights with the insured's potential exposure and the duty of utmost good faith. The insurer has a right to control the litigation and settlement process, but this right is not absolute and must be exercised with consideration for the insured's interests. The core tension lies in the insurer's desire to manage its financial exposure versus the insured's need to avoid potentially ruinous judgments that exceed policy limits. Careful judgment is required to ensure that the insurer's actions do not breach its duty to the insured. The correct approach involves the insurer seeking and obtaining the insured's informed consent before agreeing to a settlement that could expose the insured to liability beyond the policy limits. This aligns with the principle of utmost good faith, which underpins the insurer-insured relationship. Specifically, in jurisdictions like the UK, while the insurer typically controls the defense and settlement, this control is exercised within the bounds of the policy and the general law of contract and tort, including the duty of care owed by the insurer to the insured. The insurer must act reasonably and in good faith, and where a settlement might expose the insured to excess liability, obtaining the insured's consent is a crucial step in fulfilling this duty. This ensures the insured is aware of the potential consequences and has an opportunity to protect their own interests, perhaps by contributing to the settlement to avoid a larger judgment. An incorrect approach would be for the insurer to unilaterally agree to a settlement that exhausts the policy limits without consulting the insured, especially if there is a reasonable prospect of a judgment exceeding those limits. Failure to involve the insured in a decision that directly impacts their financial exposure constitutes a breach of the duty of utmost good faith and potentially a breach of the duty of care. The insurer is not merely acting in its own financial interest, but as a fiduciary in certain aspects of the claims handling process. Another incorrect approach would be to pressure the insured into consenting to a settlement without fully disclosing all material facts, including the potential for a judgment exceeding the policy limits and the insured's options. This misrepresentation or omission of information undermines the concept of informed consent and is ethically and regulatorily unacceptable. Professionals should approach such situations by first thoroughly assessing the claim's liability and quantum, including the realistic range of potential outcomes at trial. They should then communicate openly and transparently with the insured, explaining the insurer's assessment, the proposed settlement strategy, and the potential implications for the insured, particularly regarding excess exposure. If a settlement is contemplated that could lead to excess liability for the insurer must obtain explicit, informed consent from the insured. This involves providing the insured with sufficient information to make a reasoned decision and advising them to seek independent legal advice if they wish. The insurer's decision-making process should prioritize fairness and good faith, ensuring that the insured's interests are not unduly prejudiced by the insurer's pursuit of its own financial objectives. Question 16. The assessment process reveals a commercial client has experienced a ransomware attack that encrypted their internal servers, leading to a temporary disruption of business operations and the potential exposure of sensitive customer data. The client has a cyber liability insurance policy. Which of the following approaches best aligns with the insuring agreement for losses arising from cyber incidents, such as data breaches and network security failures, in determining potential coverage? Option A. Immediately assume that any ransomware attack automatically falls under the cyber incident coverage, regardless of specific policy definitions or exclusions, and proceed with a full claims investigation. Option B. Advise the client that ransomware attacks are generally excluded from cyber liability policies, and that coverage is unlikely unless explicitly stated in a specific endorsement. Option C. Focus solely on the business interruption aspect of the ransomware attack, as this is a direct financial loss, and disregard the potential data exposure unless a formal data breach notification is issued by a regulatory body. Option D. Determine if the ransomware attack constitutes a network security failure, as defined in the policy, and if the resulting data encryption and potential data exposure meet the policy's definition of a data breach, thereby triggering the insuring agreement for covered losses. The correct answer is D. Determine if the ransomware attack constitutes a network security failure, as defined in the policy, and if the resulting data encryption and potential data exposure meet the policy's definition of a data breach, thereby triggering the insuring agreement for covered losses. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how cyber insurance policies are triggered and what constitutes a covered loss under the insuring agreement, particularly in the context of evolving cyber threats and regulatory expectations. The complexity arises from the need to interpret policy language against specific incident facts, and to ensure compliance with relevant insurance regulations that govern policy interpretation and claims handling. Careful judgment is required to avoid both underinsuring the client by misinterpreting coverage and overpromising coverage that the policy does not provide, which could lead to regulatory scrutiny and professional liability. The correct approach involves a thorough review of the cyber insurance policy's insuring agreement, specifically focusing on definitions of data breach, network security failure, and loss. This approach correctly identifies that coverage is contingent upon the incident meeting the policy's defined triggers, and that the insurer's obligation is to indemnify for losses directly arising from such a covered event. This aligns with the regulatory framework's emphasis on clear and unambiguous policy language and fair claims handling, ensuring that policyholders receive the benefits for which they have paid, provided the conditions of the policy are met. It also reflects the ethical obligation to accurately represent policy coverage. An incorrect approach that focuses solely on the notification of a potential incident, without verifying if it meets the policy's insuring agreement criteria, fails to adhere to the fundamental principle of coverage. This could lead to unnecessary claims being filed, potentially impacting the insurer's loss ratios and the policyholder's claims history without a valid basis for indemnification. It also risks mismanaging client expectations regarding coverage. Another incorrect approach that assumes all cyber-related events are automatically covered under a broad cyber incident umbrella, without scrutinizing the specific definitions and exclusions within the insuring agreement, is also professionally unacceptable. This demonstrates a lack of due diligence and a failure to apply the policy's terms and conditions rigorously. Such an assumption can lead to disputes, regulatory complaints regarding misrepresentation or unfair claims practices, and ultimately, financial losses for either the insurer or the insured due to a misunderstanding of coverage scope. A professional decision-making process for similar situations should involve a systematic review of the policy's insuring agreement, definitions, and exclusions. This should be followed by a factual investigation of the incident to determine if it meets the policy's defined triggers for coverage. Communication with the client should be transparent and based on a clear understanding of the policy's terms, managing expectations appropriately. If there is ambiguity, seeking clarification from the insurer or legal counsel specializing in insurance law is a prudent step, ensuring that decisions are grounded in regulatory compliance and ethical practice. Question 17. Operational review demonstrates that a restaurant has experienced an increase in patron incidents involving intoxicated individuals causing injury to third parties. The restaurant's current commercial general liability policy has a standard insuring agreement for bodily injury and property damage, which approach best ensures the restaurant's risk management strategy adequately addresses potential claims arising from the negligent serving of alcohol. Option A. Relying on the general definition of negligence within the insuring agreement to cover any harm caused by patrons, regardless of the cause of their intoxication. Option B. Reviewing the commercial general liability policy for specific liquor liability exclusions or endorsements and assessing the need for a separate liquor liability policy or endorsement based on the jurisdiction's dram shop laws. Option C. Confirming the policy's insuring agreement broadly covers all forms of bodily injury and property damage, assuming this implicitly includes claims related to alcohol service. Option D. Assuming that any claims arising from alcohol service will be handled by the establishment's liquor license insurer, if one exists, without verifying the scope of that coverage. The correct answer is C. Confirming the policy's insuring agreement broadly covers all forms of bodily injury and property damage, assuming this implicitly includes claims related to alcohol service. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a nuanced understanding of how commercial general liability insurance policies respond to claims arising from the negligent serving of alcohol, particularly in jurisdictions with specific dram shop laws. The difficulty lies in interpreting the insuring agreement in light of these statutes, which can impose liability on establishments for injuries caused by intoxicated patrons. Insurers and brokers must accurately assess coverage to ensure clients are adequately protected while adhering to policy terms and regulatory requirements. Correct approach analysis. The correct approach involves a thorough review of the commercial general liability policy's insuring agreement, specifically focusing on exclusions and endorsements related to liquor liability. This includes understanding the scope of bodily injury and property damage as defined by the policy and the jurisdiction's laws. Crucially, it requires confirming whether the policy provides coverage for claims arising from the negligent serving of alcohol, often through a specific liquor liability endorsement, or by the absence of a broad exclusion. This approach aligns with the regulatory expectation that insurance products are sold with clear and accurate representations of coverage, ensuring policyholders understand their protection against specific risks like those covered by dram shop laws. Professionalism dictates a proactive assessment of potential coverage gaps and the provision of appropriate endorsements or separate liquor liability policies where necessary. Incorrect approaches analysis. One incorrect approach is to assume that standard commercial general liability coverage automatically includes claims arising from the negligent serving of alcohol. This fails to acknowledge that many standard CGL policies contain exclusions for liquor liability or require specific endorsements to provide such coverage. Relying on this assumption can lead to significant uncovered losses for the insured and potential professional negligence claims against the broker or insurer for misrepresenting coverage. This approach violates the regulatory duty to accurately explain policy terms and conditions. Another incorrect approach is to solely rely on the general definition of bodily injury or property damage without considering specific statutory liabilities like those imposed by dram shop laws. These laws can create liability for establishments even if the patron's intoxication was not directly caused by the establishment's negligence in serving them, but rather by their subsequent actions. Ignoring the impact of these specific laws on the scope of liability means the insurance coverage assessment is incomplete and potentially inadequate, failing to meet the client's risk management needs and regulatory expectations for comprehensive advice. A third incorrect approach is to interpret the insuring agreement in isolation from any endorsements or amendments. Liquor liability coverage is often modified or provided through specific endorsement attached to the CGL policy. Failing to review these endorsements means a critical component of the coverage assessment is missed, potentially leading to a misunderstanding of the actual protection afforded. This demonstrates a lack of due diligence and a failure to adhere to the principle that the entire policy, including all endorsements, must be considered when determining coverage. Professional reasoning. Professionals should adopt a systematic approach to assessing coverage for liquor liability. This begins with understanding the client's operations and the specific risks they face, including the potential for claims under dram shop laws. Next, a detailed review of the existing commercial general liability policy is essential, paying close attention to any liquor liability exclusions, endorsements, or definitions that might impact coverage. If the standard policy does not provide adequate protection, professionals must proactively recommend appropriate liquor liability coverage, whether through an endorsement or a separate policy, ensuring the client understands the terms, conditions, and limitations of the coverage. This process ensures compliance with regulatory requirements for fair dealing and accurate representation of insurance products. Question 18. What factors determine whether a loss arising from a contractor's faulty workmanship, resulting in damage to a client's newly constructed building, is covered under coverage A, bodily injury and property damage liability of a commercial general liability policy, considering the interplay between the insuring agreement and potential exclusions? Option A. The common understanding of what constitutes damage in the construction industry, irrespective of the policy's specific definitions and exclusions. Option B. The general reputation of the contractor and the client's perceived financial loss due to the delay in occupancy. Option C. The subjective belief of the contractor that their work was performed to a reasonable standard, regardless of the actual outcome. Option D. The specific wording of the insuring agreement defining occurrence and property damage. The precise language of any applicable exclusions, such as those for faulty workmanship or damage to the insured's product/work, and any relevant endorsements that modify these provisions. The correct answer is D. The specific wording of the insuring agreement defining occurrence and property damage, the precise language of any applicable exclusions, such as those for faulty workmanship or damage to the insured's product/work, and any relevant endorsements that modify these provisions. Explanation. This scenario presents a professional challenge because it requires the insurance professional to interpret and apply complex policy language, specifically the insuring agreement and exclusions of coverage A, bodily injury and property damage liability, in the context of a novel and potentially ambiguous claim. The difficulty lies in distinguishing between a covered occurrence and an excluded event, which often involves nuanced legal interpretation and a thorough understanding of the policy's intent and the relevant regulatory framework. Careful judgment is required to avoid both underinsuring the client by denying a valid claim and overinsuring the insurer by accepting a claim that falls outside the policy scope. The correct approach involves a meticulous review of the policy's insuring agreement, paying close attention to the definitions of occurrence, bodily injury, and property damage. This must be followed by a thorough examination of all applicable exclusions within coverage A, considering any endorsements that might modify or reinstate coverage. The professional must then assess the specific facts of the claim against these policy provisions, seeking to understand the proximate cause of the loss and whether it aligns with the policy's intent. This approach is correct because it adheres to the fundamental principles of insurance contract interpretation, which prioritize the clear language of the policy and the regulatory requirements governing its application. It ensures that coverage decisions are based on objective policy terms and established legal precedents, thereby upholding the contractual obligations between the insurer and the insured, and complying with regulatory mandates for fair claims handling. An incorrect approach would be to rely solely on the insured's subjective interpretation of the event, or to make a coverage decision based on industry custom, without a direct link to the policy wording. This fails to acknowledge that insurance policies are legally binding contracts, and their interpretation must be grounded in their specific terms. Such an approach risks violating regulatory requirements for claims handling, which mandate that decisions be based on policy provisions and evidence, not on assumptions or external factors. Another incorrect approach would be to broadly interpret exclusions to deny coverage whenever there is any potential ambiguity, without considering the overall intent of the insuring agreement or any applicable legal doctrines that might limit the scope of an exclusion. This can lead to unfair claim denials, potentially violating regulations that prohibit unfair or deceptive practices in the insurance industry and undermining the principle of indemnity. A further incorrect approach would be to apply a common-sense interpretation of the event without rigorously comparing it to the precise definitions and limitations outlined in the policy. While common sense can be a starting point, it is insufficient for making a legally sound coverage determination. This approach neglects the specific legal and contractual obligations established by the policy and the regulatory framework, potentially leading to disputes and regulatory scrutiny. The professional decision-making process for similar situations should involve a systematic, evidence-based approach. First, thoroughly understand the facts of the claim. Second, meticulously review the relevant policy provisions, including the insuring agreement, definitions, exclusions, and endorsements. Third, research applicable case law and regulatory guidance related to similar claims and policy language. Fourth, apply the policy language and legal precedents to the facts of the claim, identifying the proximate cause of the loss. Fifth, document the entire decision-making process, including the rationale for the coverage determination. This structured approach ensures that coverage decisions are fair, consistent, compliant with regulation, and defensible. Question 19. Examination of the data shows a restaurant with a full-service bar has a standard commercial general liability (CGL) policy. The risk manager is reviewing the policy to ensure adequate protection against potential claims arising from the sale or service of alcoholic beverages. Which of the following approaches best ensures the restaurant is adequately protected for liquor liability exposures? Option A. Confirming the CGL policy contains a specific liquor liability endorsement that clearly defines coverage limits and exclusions for claims arising from the sale or service of alcohol. Option B. Assuming the CGL policy's general liability coverage implicitly includes protection for liquor-related incidents. Option C. Prioritizing the lowest premium offering for a general liability policy without detailed review of liquor liability clauses. Option D. Relying on the insurer's standard policy wording without verifying specific liquor liability provisions. The correct answer is A. Confirming the CGL policy contains a specific liquor liability endorsement that clearly defines coverage limits and exclusions for claims arising from the sale or service of alcohol. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of liquor liability insurance beyond a basic policy review. The risk manager must assess the adequacy of coverage in relation to the specific operational risks of a licensed establishment, considering potential legal exposures and the evolving regulatory landscape. The challenge lies in identifying potential gaps in coverage that could lead to significant financial and reputational damage for the insured. The correct approach involves a comprehensive review of the insured's operations, including their service policies, staff training on responsible alcohol service, and any history of incidents. This proactive assessment allows for the identification of specific liquor liability exposures that may not be adequately addressed by a standard commercial general liability policy. By recommending a dedicated liquor liability policy or an endorsement that specifically covers the identified risks, the risk manager ensures the insured has appropriate protection against claims arising from serving alcohol to intoxicated individuals or minors, which aligns with the principles of prudent risk management and the regulatory intent to protect the public. This approach is ethically sound as it prioritizes the client's best interests by ensuring adequate coverage for known risks. An incorrect approach would be to assume that a standard commercial general liability (CGL) policy automatically provides sufficient liquor liability coverage. This fails to acknowledge that many CGL policies contain exclusions for liquor liability or provide very limited coverage, necessitating a separate liquor liability policy or endorsement. Relying solely on the CGL policy without specific verification of liquor liability coverage is a regulatory failure, as it may leave the insured exposed to significant uninsured losses, potentially violating the duty of care owed to the client. Another incorrect approach is to simply accept the insurer's standard offering without further investigation. This overlooks the critical need to tailor insurance solutions to the unique risk profile of the insured. Insurers may offer a one-size-fits-all product that does not adequately address the specific operational risks of a particular establishment, such as a high-volume bar versus a restaurant with a limited bar service. This can lead to underinsurance and a failure to meet the insured's risk management objectives, which is an ethical lapse in professional responsibility. Finally, an incorrect approach would be to focus solely on the premium cost without a thorough risk assessment. While cost is a factor, prioritizing the lowest premium over adequate coverage is a fundamental error in risk management. This can result in a policy that is insufficient to cover potential claims, leading to greater financial hardship for the insured in the long run. This approach demonstrates a lack of professional judgment and a failure to uphold the fiduciary duty to the client. The professional decision-making process for similar situations should involve a systematic risk assessment of the insured's operations, a thorough understanding of available insurance products and their limitations, and clear communication with the client about identified risks and recommended coverage. This includes verifying specific policy language, exclusions, and endorsements related to liquor liability. Question 20. When evaluating potential vicarious liability for the actions of a service provider who is not a direct employee, a commercial liability risk manager is presented with a situation where the service provider operates under a contract explicitly stating they are an independent contractor. However, the company dictates the specific hours of work, provides all necessary tools and equipment, and closely supervises the day-to-day execution of the tasks. The service provider has also signed a waiver of liability, which approach best reflects a sound risk management strategy in this context. Option A. Conclude that since the service provider is not a direct employee, the company has no responsibility, regardless of the level of supervision or provision of tools. Option B. Rely solely on the signed waiver of liability as sufficient protection against any claims arising from the service provider's actions. Option C. Conduct a detailed review of the actual working relationship, focusing on the degree of control exercised by the company, the provision of resources, and the nature of the payment, to determine the true legal status of the service provider and assess the enforceability of the waiver. Option D. Assume the service provider is an independent contractor due to the contract and the signed waiver, and therefore the company bears no vicarious liability. The correct answer is D. Assume the service provider is an independent contractor due to the contract and the signed waiver, and therefore the company bears no vicarious liability. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of vicarious liability, specifically the distinction between employees and independent contractors, and how this impacts an organization's risk exposure. The core difficulty lies in accurately classifying the relationship and applying the correct legal principles to determine responsibility for the actions of a third party. Misclassification can lead to significant financial and reputational damage. The correct approach involves a thorough investigation into the nature of the relationship between the company and the individual providing services. This includes examining the degree of control the company exercises over how the work is performed, the method of payment, the provision of tools and equipment, and the exclusivity of the engagement. If the evidence points towards an employer-employee relationship, the company is likely to be held vicariously liable for the employee's negligent actions performed within the scope of their employment. This is justified by the legal principle that an employer benefits from the work of their employees and therefore should bear the responsibility for their actions, fostering a safer working environment and ensuring victims have recourse. Regulatory frameworks, such as those governing employment law and tort liability, underpin this principle. An incorrect approach would be to solely rely on the contractual label of independent contractor, without scrutinizing the reality of the working relationship. This fails to acknowledge that courts often look beyond the contract to the substance of the arrangement. The regulatory and ethical failure here is a disregard for established legal tests for employment status, potentially exposing the company to unforeseen liabilities and failing to adequately manage risk. Another incorrect approach is to assume that because the individual signed a waiver of liability, the company is absolved of all responsibility. While waivers can be relevant, they are not always enforceable, particularly in cases of negligence where public policy may prevent their application, or if the waiver is deemed unfair or unconscionable. The regulatory and ethical failure is an over-reliance on a potentially invalid legal instrument, neglecting the broader legal and ethical obligations to prevent harm and ensure accountability. A further incorrect approach is to dismiss the incident entirely because the individual was not a direct employee, without considering the possibility of direct negligence on the part of the company in selecting, training, or supervising the individual, even if they were an independent contractor. This overlooks the company's own duty of care. The regulatory and ethical failure is a failure to conduct a comprehensive risk assessment that considers all potential avenues of liability, including the company's own potential direct fault. Professionals should adopt a decision-making framework that prioritizes a factual investigation into the nature of the relationship, applying established legal tests for employment status. This should be coupled with an assessment of the company's own direct duties of care and the enforceability of any contractual provisions. A proactive approach to risk management, including clear contractual terms, appropriate insurance coverage, and robust oversight mechanisms, is essential to mitigate vicarious liability.